All right, everyone. Welcome back to another episode of Bell Curve. Before we jump in, quick disclaimer. The views expressed by my co-host today are their personal views, and they do not represent the views of any organization with which the co-hosts are associated with. Nothing in the episode is construed or relied upon as financial, technical, tax, legal, or other advice. You know the deal. Now, let's jump into the episode.
All right, everyone. Welcome back to another roundup of Bell Curve. You got Michael's 1 and 2, Vance and Yano. What's going on, fellas?
Yo, you guys were roasting me last week. You guys, I listened in. I was getting shredded.
You weren't supposed to hear that.
I was getting shredded on Bell Curve. I'm listening.
We didn't think that was
expecting
recording,
a nice
actually,
little roundup,
so,
and you guys are talking about my bald head. My God.
Yeah, no, I'm sorry. It's awkward to have you back here.
Well, what's awkward, Michael, is the big hair reveal that you're about to do for us. So I think I got to get you back, my friend. You're looking, ooh,
bussin', baby, bussin'.
Dana taught me a new word I'm supposed to know, which is snatch.
What's that mean?
In what context?
In what context, friend?
No, like I don't even know how to use it. It's like Michael's looking snatch. I don't know. We need some Gen Zers to tell me how to do this.
I'm not 100% sure on that one. You might want to wait on that till you get further comfort. I actually learned another Gen Z one this week, which is brick. You guys know what that means?
Like failing, kind of?
Like it's freezing.
You play
cold.
basketball?
Like it's cold as brick. Like I was gonna come visit you, but it was brick. It was brick out.
It's cold. Okay. I heard risen. You ever heard of risen? Like I'm risen over something?
Yeah.
No, I don't know that one.
You got Riz? Yeah.
Yeah, you're excited. You're like feeling good.
I went to a bar trivia night here in New York, and the whole category was Riz. And for the whole first 2 minutes, we're like, what did they say? Like, what is that word?
Could you spell that for us, please?
Yeah. Whole English language out here getting reinvented right from under our feet. All right. I actually want to make this a non-macro podcast for a change and get some thoughts on crypto specific stuff. So I would love to get your thoughts on kind of the two dominant stablecoins, USDC and Tether. So we've kind of seen some pretty significant outflows from USDC, and Tether is ostensibly kind of looking at Tether dominance is going up. It's looking like the safe haven. At least that's what it looks like on the surface. So I'd be very curious to sort of understand what you guys think about this.
Obviously, since the Silicon Valley issue, whatever we want to call it, had a number of conversations with portfolio founders. I would say uniform across the board, and also in surprise to us, the move was to put it into Tether. Basically, like take all the cash that you had. Banks were not safe. USDC was not safe. Put it into Tether, and that was kind of the safe hold of where you wanted to put value, for a short duration. Obviously, everybody else has now moved to some sort of banking solution or banking infrastructure, but it was very surprising to me, at least over the last 2 weeks, that uniformly Tether was the thing that everybody immediately went to and said, this is the place that we want to keep our value. Obviously we saw USDC depaid. You saw all the kerfluffle around that. Also talked to a couple of people over the last week who were trading USDC as it was depaying, and it seems like that was a pretty awesome trade. But yeah, it feels like there is an opportunity to have something be the reserve currency. And in a lot of ways, it seems like Tether has been that by default.
Yeah, I'm just looking at the total market cap. Looks like it peaked at 56 and now it's at 33. Peaked at 56 billion in July of 2022. It's kind of the same thing you see with like the bank runs, right? And it's not just, the speed of mobile phones. It's literally just 2 Ethereum transactions away, 24/7, 365. So you're seeing like finance at the speed of the internet. And it's not surprising that there's this much volatility. I also think there's probably a lot of latent USDC that was just sitting there for one reason or the other. And this was the event that woke people up to either getting to a new stablecoin or putting it into T-bills or things that are on chain like Ondo. But I kind of wonder where this stops. Like 30 billion seems like like, you can't really do TA on this chart, but seems like a decent place for it to stop if it were going to. But yeah, USDC kind of getting killed here, and Circle as a result.
Yeah. So just to give people some numbers, it's down from peak, or about 90 days ago, it's about 43 billion in terms of market cap. Today it's 32. Rough math says 11 billion in outflows.
Does it have something to do with where they invest, where like what it's collateralized by? Like one of them is invested. If you knew nothing about the backstory of Tether and nothing about like, oh, USDC is more reputable, it's like on paper, one of them invests in US bank deposits and the other invests in short-term treasuries.
Yeah, I think there's some additional hair on like the USDT thing. Like frankly, like we have a lot of USDC. I wouldn't trust Tether with our balances just because it's kind of indefensible for us to go to our LPs if something were to happen to Tether and say, yeah, this offshore, banking operation that has like this checkered past versus something that's holding T-bills in US, systematically important banks. So like I continue to think the institutions are just going to be USDC, but I think what you're seeing is just Asia does not have that same understanding, and frankly, like probably just has a bit more history with USDT versus something that looks a little bit more regulated like USDC.
Is there any chance that Tether is like interacting with you? I don't really understand how like Tether's mechanism or whatever, like the burning and stuff like that. It never really made sense to me. Is there any way that Tether's interacting with USDC in some way?
Doubtful.
Doubtful. I think they would need to keep pretty clean lines between each of them, just in order.
I think if you own Tether, you need to have a very strong thesis about why it has been able to stay so steady despite all of the turbulence out there in the market. Like, you need to have a good explanation. Like, are they that much better at risk management? Are their bond traders just dodging every bullet that exists out there? I don't know. I've never been able to construct a compelling thesis for why it's been so solid. It doesn't make much sense to me.
We had a conversation with a market maker, and granted, this was like probably April 2020. So take it with a grain of salt, as a lot of shit has changed since then. We had a conversation with a market maker, a very, very large, reputable market maker, and they said, listen, you got to understand what Southeast Asia is like. When you go to Kowloon and actually see some of the FX prices in the international currency exchange, they're quoted in Tether. They're quoted in the base currency, which is USDT. So I think there is an infrastructure, and it's probably not an infrastructure that we're used to seeing, that has Tether as a core component, where it's the base currency, it's the base trading pair. And I think that, is really kind of, Mike, to your point, like, where is this happening? Why is this happening? I think that's a lot of the infrastructure that, props up this currency.
So one like little data point that I would throw at you guys is there was there's another Blockworks also puts out a lot of macro content. I'm actually the host of a small macro podcast called On the Margin, and what people were talking about a couple, like probably 18 or so months ago, I forget the exact timeline, was, do you guys remember when there was a big Chinese real estate firm called Evergrande that was imploding? Yeah. And the concern at that period of time was because all of the macro kind of trader folks, what people always say about Tether is, I have never met anyone who trades for Tether. Like, that's what all like the bond traders would say, right? In like US based banks and stuff like that. It's like, for an entity that supposedly has a gigantic, multi-billion portfolio of bonds, I've never met anyone that trades for Tether. So then the thought was, all right, well, maybe what they're doing, they have exposure to Chinese paper. And then Evergrande happened. And then that was actually dispelled. And Tether came out and said, we had no exposure to Evergrande, which basically meant that you couldn't have exposure to China at that point. So then the question becomes, if you're not trading in US treasuries and you don't have any exposure to Chinese debt, where is that, however big it is now, $45-50 billion bond portfolio sitting?
They do have attestations. It's like, it's on paper somewhere. I don't know what the exact locations of the money are, but assuming those attestations are good, I see a compelling reason for people to use this. There's also different, like one of the different things about USDT versus USDC is there's a pretty robust culture of trading USDT OTC. which sounds a bit strange, but that's how people, first of all, off ramp from a lot of Chinese exchanges. You will go into these like kind of like OTC markets, and they used to be more active when China was really running strong with crypto, and I assume they're active again now that Hong Kong is back. But you would really kind of use your account as a bartering chip to get stable coins, which you would then convert into bank deposits, and that's how 90% of people that trade in China, that at least I know, have actually used this. So a little bit different of a use case as well. And there's a network of brokers which will do this for you, and who knows how active they are now, but there's a pretty robust culture of like trading, peer-to-peer, like USDT, as strange as that seems.
I have no special information. I just it has never made an enormous amount of sense to me. So that's why I kind of was like, I think you need a very strong thesis as to where that money is and why they might have been so impervious to this. But it's actually almost 80 billion in market cap, which is larger than I thought. And if you look at the charts of USDC versus Tether market cap, they're basically inverses of each other.
Think about this, pretty incredible business model. No matter what, USDC, Tether, any of these stablecoins, if you're able to take deposits in to the tune of 80 billion or $100 billion, earn 3, 4, 5%, whatever it may be, or maybe less, sure, but like 2, 3, 4%, and then you're not paying out any interest. Pretty awesome.
It's pretty awesome. But Tether should have the same or honestly, I kind of feel like all of them should have similar problem that the banks had, in that when they were originally generated all that market cap and had to put it in treasuries, they were doing that at a time when yields were pretty low. But I don't think USDC should be totally fine. That's why I'm with you guys. USDC is completely audited. They're very transparent, like a high degree of confidence that there's legitimate backing there.
It's not the same thing, because USDC, I think the average tenor of all the fixed assets that they have backing up the USDC is like 3 months. They cycle these very, very rapidly. So it really matters what like the short duration of the yield curve is in terms of what their yield is, in terms of what the revenue will be. But it's not like, they're going to get stuck with these hold to maturity securities. Like they're not the same issue as the banks.
Ultimately, I hope the T-bills end up on chain, and instead of stable coins as like the base foundational layer of DeFi, you have something that's yield generative. Just because if you have something that's yield generative, your ecosystem is going to default grow by whatever that yield is year over year, and so you at least like have like a little bit of a tailwind, and people are a little bit more enfranchised. And there's a cool product out there called Ondo, which does OUSG, which is I think like 2 or 10 or whatever year government fixed income. The problem with those products is that you can't actually get wide distribution, because everyone that buys them needs to be an accredited investor or a qualified purchaser, which, if you don't know what that means, it usually means there's like a net worth threshold, which is, bullshit. We don't agree with, but there is a threshold for people who can actually buy these things. And so as a result, you're signing up with Ondo to create, a registration in a security, which is a fund. You own an LP stake. And so I don't know how you ever solve that, but my hope is that we can. And I don't think you can do these things synthetically either. I feel like that would just be a lot of risk for the people who are on the other side of the trade. But my hope is that this is where this goes, and maybe we see it come out of a different country. Maybe Europe has, different laws around who can own government fixed income and who can trade it and things like that. Maybe it's like Asian bonds, but someone's going to start doing this, just because the stablecoin business model, to Michael's point, is just extremely juicy. And I'm happy they have the business right now. I'm happy they have the revenue, because they're going to need it to fight a lot of lawsuits and lobby and do a lot of different things to make, the future finance, happen. But it's my hope that it trends the other way over time, more towards giving yield to the ecosystem and consumers.
Did you guys read Coinbase's kind of almost call to actions, I guess I'd call them, for builders? The 4 things that they wanted folks to build.
No, what was it?
So Coinbase launched Base. Base basically has like an ecosystem fund, and they just put out like the 4 things they want to see built. One was like things that help enable safer DeFi. Another was reputation. Another was like on-chain limit order books, and then the last one was what they called flat coins, which are basically decentralized stables. And specifically, they brought up like they're like, we have a request for like builders to go build decentralized stables that are like inflation hedged or like track the growth of inflation, whatever you want to call it. And yeah, I'm curious what you guys think about that.
Sounds like an amazing concept. In concept, exceedingly difficult to execute on. I mean, to Vance's point, like Ondo exists. There are real world asset pools. Maple is a great example of this. A portfolio company, a framework. Um, there are also on chain, insurance pools that you can put money into that are like literally insuring tow truck drivers and crop insurance. Like there are ways to get yield that I think are interesting. The problem is that you literally need to sign documents or do some sort of signature on chain such that you're effectively an LP in a fund. That doesn't work if you're not someone who can pass KYC. That doesn't work if you're not, from the jurisdiction, and frankly, just like doesn't work if you're an individual that doesn't want to sign, LP documents. There is a need for KYC and all of the process around, fund formation and the like, but the entire point is that there isn't really an opportunity to have someone access this product without effectively like signing LP documents, which is, and just to be clear, like that's way different from, for instance, like having a brokerage account where you can get access to these money market funds. That's way different from anything that we have on chain. If you're using Ondo Finance, you literally have to, effectively sign to be a qualified purchaser, which is a wealth threshold of $5 million. So, there are high levels of access constraints that effectuate whether or not you can have access to this product, even in DeFi. So I agree. It's awesome to conceptualize, but very, very difficult to effectuate.
I've heard a couple of VCs say they're not necessarily fans of early stage companies holding their treasury in even something as safe as T-bills, just because you don't have like an enormous amount of financial competence at an early stage company, and it doesn't happen super often. But if you held treasuries, depending on the duration in 2022, you might have lost, 25% of your treasury. So I'd be curious what you guys just kind of think about holding treasuries, or like what is treasury management supposed to look like for early stage startups?
Don't do that. Don't just hold your money in cash in a bank. Like, just to replay, this is my opinion, just to replay FTX. Like, okay, you're a startup, you had your money in FTX. What was the money doing in FTX? Well, we were trying to, buy euros, and like, because we had to pay people in euros, or like we thought we could get some yield. It's like, okay, are you running a hedge fund? Like what are you doing? That's at least my perspective. I don't think the risk can really, or the reward can really ever outweigh the risk if mission one is getting your product to market and keeping your team alive. If you're the CEO of the company, you really have two jobs, keeping the company funded and keeping everyone in line. And like, if you blow your company up because you put all your money in, I don't really care where, that's your fault.
So one of the things I was going to add to this is a month ago, I would have said absolutely 100%. That makes total sense. After the last month, everything we've seen with Silicon Valley Bank, replace FTX with Silicon Valley Bank and replace the situation that happened versus what could have happened, which is depositors don't get 100% of their money back, or it goes into receivership and you have to fight for it over the next 24 months. The thing that I think is important to note is like there is a very huge difference between $250,000 of FDIC insurance versus how much money your company probably needs to raise to be able to pay operations over the next 2 years, which is, what you should have. There are cash sweep accounts, there are money market funds. You don't have to go off and buy T-bills, but there are places where as interest rates ebb and flow, you're not going to lose value on the actual value that you have in your account. And in fact, you probably will gain value. But I think keeping it in a money market fund is probably, the best opportunity here, given everything that's going on, as crazy as it sounds, in the banking sector.
So then how do you grapple with the fact that a lot of the protocols that you guys invest in still hold a decent chunk of their treasury in their own native token.
Their own native token or USDC?
Their own native token, from what I've seen.
Yeah, I mean, you kind of think of it as like operating expense versus incentive fund. You have USDC or you have cash, stablecoins as the way to pay people, and that's the salaries that are coming out every 2 weeks or whatever it is. And then you have tokens that are incentivizing the team, incentivizing the community to go off and be aligned with the rest of the community, with the rest of the protocol. And yeah, sure, a lot of treasuries are denominated or effectively denominated in the currency that they have, but it's kind of like saying, the employee stock option pool is denominated in the company stock.
That makes sense. All right, guys, let's talk a little bit about, I know you guys flagged a report that was written this week on CBDCs. That was by Citi, and kind of the combination of that in real world assets, or the sort of real world asset, real estate tokenization trend that we've been seeing. You guys talk a little bit about that.
I personally have a pretty negative view on CBDCs. I don't think, like, we all have digital money in our bank accounts. Every time we use Apple Pay, every time we use a credit card, we have digital money already. The only reason why you would have a CBDC on like the consumer payment side is to be able to have not only read permission, which the government already does into basically every financial transaction, but also write access and be able to reverse things, to be able to block things, to be able to subtract money, to be able to add money. I personally just think that's a pretty slippery slope. And I think it's pretty cool that Ron DeSantis banned CBDCs in Florida. Big shout out to him for realizing that this is probably not a path that we want to go down.
I think it becomes another veneer, a layer of privacy control. Frankly, in my mind, we already have a CBDC, and sure, it traded off peg, but USDC is redeemable for $1 as long as you have a bank account that can receive it. And in my mind, that's really kind of the fastest, the best. It's also really interesting that FedNow is apparently launching in July. We'll see, what that is and what that does. But I do generally think, there is definitely going to be competition from, the public sector that's coming to the private sector, which is Circle and USDC.
The expectation, I don't know if you saw that, if you guys dug into the paper, but I think the number they floated out was like 5 trillion. 5 trillion of CBDCs circulating in the economy within 7 years.
Like the one thing that I would say is an interesting use case for central bank. I don't know if it's like central bank digital currencies, but I'm going to tie the macro to the crypto here. Like if you think about things like the TGA, which is the Treasury General Account, or the RRP, which is the reverse repurchase facility, like those things have trillions of dollars in them, and the Fed is trying to get this money, through incentives to move into or out of these programs, or into or out of the banks, or into or out of the financial markets. And it all kind of seems like it's pretty manual and stuck together by like duct tape. Like if you had all of these assets, say like the central bank issued all the T-bill auctions on chain and had all those assets on chain, and maybe they had read and write permissions, and maybe they could, give people incentives to move into these places, or, penalize them to move out. Like, if you assume that monetary policy is one of the most important things that, the US is doing today, it kind of doesn't make a whole lot of sense that we're running on probably like 1960s technology. So I think like central bank digital assets, not central bank digital currencies, are pretty interesting. Like imagine if the RRP was on chain. Like that.
Yeah, but you're basically trading off. Yeah, but then you're basically trading off efficiency. It's like, yeah, they improved the antiquated ACH system, obviously, drastically, right? Imagine there's another global health pandemic, country shuts down, you're out of work, government announces a stimulus plan, same day, stimmy checks could hit your bank account. Like, yeah, that's a big improvement, but what you're trading off is privacy, control, and surveillance. Because in that same world, the government could then block your transactions if you attend a protest that they disagree with, or even worse, they can shut down your entire account if you post. Let's say you post on social media in favor of like some riots or something like that, like then they can shut down your account. And I think it's not, that's why I'm like, I think CBDCs have like a potential to be one of the most dangerous things. In the
this is already happening too. People are already getting financially deplatformed.
I'm like very anti CBDC.
Yeah.
That's why Ron DeSantis, he's the truth.
Are we starting that
D.
narrative this
Ronnie
early,
D.
Vance?
No, too early.
Too early.
Guys,
Walk it back.
I know the caucuses start in January. It's like 7 months away. And then, like, once, if DeSantis announces in the next couple months, that's all people are going to be talking about for the next 18 months.
Once if he announces.
I think I was actually a little worried about, we're moving our DAS event to Washington, D.C., and we've been kind of doing I mentioned to you guys a couple of times, we've been doing some research and talking to people down there. And it's been a little worrying to hear that what everyone wants to hear about and what people think are going to be relevant is going to be relevant a year from today is CBDCs. And I would say the majority of people, they view it as inevitable that it's happening on a relatively shorter time frame than I think most would be.
This news kind of flew under the radar, but I think it's one of the more interesting pieces of news over the last week. Did anyone see what happened with Matt Taibbi the day that he went to go testify in front of Congress?
Yeah, the house arrest.
No, not house arrest, but like
Or yeah,
got put under house arrest. No, some IRS agent rolled up to his house and left him like a note, which was like, call the IRS in the next 4 days.
Yeah.
Not just that. His existing tax returns were refuted. Basically, the IRS said over the last 3 years, the tax returns that you have, we're rejecting them and we are reopening forensic audits into your tax returns. The day that he was supposed to go and testify in front of Congress on the Twitter files.
Imagine if they could automate that and just take all his money and just be like, sorry.
There is an executive control that I think, cannot go understated here that we need to protect. And this is the entire conversation around CBDCs. Yes, Ron DeSantis, pro anti CBDCs, but the fact of the matter is any sort of control left unchecked. I mean, who's going to be the one who regulates the CBDC? Who's going to be the one who actually controls whether or not, these things and these powers can happen? Did you see the the TikTok proposal? And granted, it's a proposal that's not going to it's not going to go into effect. 20 years imprisonment if you access the application from a VPN. The Secretary of Communications, which is a new cabinet position that the president would, appoint, an unelected person would choose a council of people beneath them to decide which applications should be banned, which countries are foreign adversaries. How are we going to have any sort of checks and balances into that control? And there's a governmental overreach that I think is kind of the core to what CBDCs represent, but it's happening not just on the financial side; it's happening on the communication side as well.
You know what I think is particularly dangerous about this is look at what's happening in with regional versus big banks. There's already a natural economic trend that flows towards this anyway. Like our whole fractional reserve banking system is basically levered bond funds in a way. And those are inherently risky and they kind of blow up from time to time. And every once in a while, when these bank failures start, people are like, well, I should just be able to park my money in somewhere that I don't have to risk it getting, losing my money. That should just exist as a product. And, the benevolent side, like imagine a very benevolent kind of technocrat in charge of this. And it's like, well, how could I give people what they want and also make my life easier, and that all roads lead to CBDC, or even if it's not a CBDC, I'd argue that there's not a gigantic difference in between a world where there's a CBDC by our definition versus the Fed and like 5 or 6 big banks, because that's just, to use crypto terminology, that's just a base layer with 1 node and then a layer 2 with like 4 or 5 nodes. I mean, those aren't real. I don't know what the difference really is. I kind of agree. I think we're not that far away from a CBDC. And yeah, I find it extremely concerning. I echo all those concerns that you made, Jason. It's a massive overreach, I think, from government.
Just to be clear, we believe that there will be some sort of legislation that gets bipartisan support, therefore approved in the next call it 18 months for stablecoins, we don't believe that there will be anything that happens in the next 18 months on CBDCs.
Oh my God, the CBDCs are going to move at the pace of government. Like, how long have we been waiting for Fed now? It's going to be a while until this is reality.
Yeah, I remember we had a call with Christopher Giancarlo, I think was his name, the CFTC chair, and like, when was that, Mike? We were talking about DASP. I don't know if you were on that call. It was like mid 2020, and he was explaining to us how like a tokenized US dollar is going to be built and how it's going to happen faster than we realize, and that was 3 years ago.
Yeah, the same people that brought you the post office are going to build this CBDC, and it's literally going to go 0 places.
I will say, post office, very impressive.
Post office is pretty good.
All right,
very
impressive.
The original, yeah.
How about the DMV? Like
DMV, less than
The DMV, let's
post
throw it
office
out.
is kind of wild. Yeah,
DMV is state, bro. It's not
same difference to me. I don't care. No nuance.
Listen, faster than you expect means less than 25 years.
Yep. It's kind of interesting this week. Like we've both seen like the CBDCs are like too powerful for humans, and also like the AI is too powerful humans echo sentiment. It feels like we're getting to this point where like maybe we can't control all these like power tools. Maybe these aren't good for us.
So here's what I think is going to happen with CBDCs. Just to capstone this point, they're going to happen elsewhere, and the U.S. is going to be probably one of the last places that would implement a CBDC. We're going to see test cases in South America. We're going to see them in Southeast Asia. We're going to see them in Europe, and those are going to be the examples that we use and leverage and identify to test and see. But it's not going to be something that happens in the U.S. at least, for the foreseeable future.
I hope you're right. I don't know. If I like really tried to put myself in the shoes of a technocrat in charge of this stuff, it's very easy to say, I'm solving people's problems. I'm giving people what they want, and I get to make my life easier in the first place. And the thing that I would just say that's a little bit different this time than Jason, when you and I were talking to that person 3 years ago, is banks weren't blowing up in that period of time. And that can hasten these sorts of solutions. It's a really elegant solution for solving the problem in a way. Do you know what I mean? It gives people what they want, and they get this thing that they really want.
I think what will speed it up is not the like collapse of SVB and all that kind of stuff, but the narrative that the US is losing its global reserve currency status is like not in the mainstream yet, but it will be in like a year from now. And I think if you go back and read that, like the Giancarlo paper that they wrote, the like one of the main points was that a CBDC would help the digital dollar remain the global reserve currency. And so
Fareed Zakaria was on CNN screaming bloody murder
this.
about how the US dollar was, going into the tubes.
Really?
If CNN is covering it, it's already over.
I saw it on Hood Ratchet. Hood Ratchet News. It's an Instagram account that I follow.
Anymore.
Mike, what is your content diet? You must have such a good content diet. Hood Ratchet.
Just a lot of zero
zeitgeist. I like to stand the zeitgeist, yeah.
Did you know that CNN is not a top 20 news organization anymore?
Based on page views?
Based on
based on total.
Based on what Ron DeSantis told you, or
no, based on total viewership across all their platforms. It's
all about Newsmax now.
True Social.
It's like, have you heard of this little gem called Breitbart? I'd never heard of this, but I just found it on that. It's a little gem on the web.
We tried so hard not to make this a macro podcast.
540 million page views a month on CNN.
Good God. So if Optimism and Arbitrum are like the canonical 2 L2s, and like you're a successful application that builds on either of them and has a lot of success, why would you stay on that L2 versus just building your own thing like Coinbase? Is the model for L2s going into the future just like these two big kind of monoliths with a bunch of L3s? Or as a project, would you prefer to be an L2?
I think it's a really good question. I don't really understand why. Yeah. I think that's already kind of happening with like even the OP stack and Coinbase's decision to not launch as a layer 3, but as their own competing layer 2, I think says a lot.
Like I had a conversation with somebody today and they were like, these L2s are going to be worth hundreds of billions of dollars. I was like, okay, how do we get there? And what are the assumptions that you need for that to be true? And like the crux of it is do you eventually just want to own everything as an application? Like the few games that we're very excited about, like in terms of, that are launching soon, that are, high quality, that, have a chance to bring on tens of millions of users, they want the whole stack. They want the DeFi, they want the MEV from the transactions, they want the fees from payments that go back and forth. Like I'm increasingly convinced that it's going to be a different model than we think, and B, just the pressures of people wanting their own L2s and the ability to just cross-layer message and be wherever you want and access whatever you want on any other L2 is going to change the entire landscape of investing in this type of stuff. That's kind of what I was thinking about this morning.
It sounds reductive to say this, but I think it comes down to two variables. Number one, it's cost. And number two, it's essentially like feasibility. Like what is the layer 2 versus the app chain versus the layer 3 versus whatever infrastructure stack you're proposing? What does that enable versus the other options? When I was at Dropbox, one of the big things that we went through, and Dropbox from 2007, 2005 when it started until about 2014 was 100% based around AWS. Think of it as like cloud storage brought to you by Amazon Web Services. And one of the big things that the team went through in 2013, 2014 was, do we go off and build our own infrastructure to be able to, when Dropbox is down, pick up the phone and call a Dropbox employee versus an Amazon employee? Like there were so many different NPV, net present value calculations done. There were so many strategic analyses. Ultimately, we moved in the direction of building our own infrastructure. Also, fun fact, the fastest way to move that much data? You literally rip out the hard drives, put them on trucks, and drive them to a new data center. That's the fastest way to move that much data. The fact of the matter is, ultimately, the NPV positive analysis that was done was NPV negative when all was said and done. Because Amazon just kept on getting faster, it kept on getting better, it kept on getting cheaper. There is an element where I think it really comes down to what is the infrastructure stack and what does it cost to build the application, that it's hard to project out which L2, L3 app chain is going to work, which one of those models is going to be the best. But it really comes down to what do you need as an application and how much is it going to cost you?
I think you're right about that. I think one thing, we've talked a little about ETH and Cosmos on this podcast, and this whole app chain thesis that got born kind of in Cosmos and has now migrated its way to ETH. And the game is all about execution. So I can totally see the kind of bull argument for what's playing out on Arbitrum and Optimism. I do think though that the different, one thing that crypto hasn't really had to contend with yet is users, frankly, to just be totally honest. And one different starting point, just having gotten in the weeds with a lot of people that are there's no, I'm not meaning to throw shade. It's just very different perspectives. People from the Ethereum Foundation tend to approach things from when you're designing an economic system like MEV, a lot of times from the perspective of Ethereum. What does Ethereum, the network, need to be in order to be this decentralized, neutral base layer? But people in Cosmos approach things very differently, and they say what is the best user experience? And I actually think that ETH should be approaching it exactly the way that it is now, but that's not to say that there isn't another perspective. And after the job of building that neutral, censorship resistant base layer is done, there's an enormous amount of wood that needs to get chopped on just building for users. And I think a lot of teams will figure out, to your point, Mike, maybe Vance, these layer 2s won't be worth hundreds of billions. They'll be worth a lot of money, and they'll be able to raise a lot of capital. And they'll probably say to themselves, I'll recruit my own network of sequencers or whatever it is. I need to have 100% control over my product and my user experience. So I think there probably will be a lot of teams that go out and say that.
It just feels a little bit weird right now that it's the L2s that Arbitrum and Optimism have built are ostensibly what everyone will build in the future. And so that is probably not their real product. It's these L3s where you use Arbitrum or Optimism to settle on. And I think that's the question you really have to ask these developers. Is it like, do you want that? Or do you want to build on ETH? Assume all the costs are equal. And I think that is going to be probably just a war of like BD and like bringing people on, or the branding of the chain itself. But it's unclear to me how it all resolves, because like, congratulations, Optimism, Arbitrum, you've created amazing copy paste networks that we can just deploy for things like Base and for things like consumer app chains and stuff like that. So kind of hard to understand right now.
I think Mike, you hit the nail on the head in that we've never had to build infrastructure for a mass of users. We've also never had to build applications for massive users. The whole model of everything that everyone has ever built in crypto gets thrown out the window the second that you have, you go from thousands of users to millions of users. It's going to be really fascinating to see that transition.
Mike, what are your updated thoughts on like, now that Arbitrum and stuff and Optimism have like pushed forward this kind of like L3 narrative, and like AppChains on ETH is becoming a thing. But then I know you were pretty bullish on Cosmos after that season.
People in crypto tend to make a lot of very like technical arguments about stuff, and I understand there's like good reason to do that. There's a lot of like soft stuff that I think gets totally glossed over. Things like brand, things like culture, that kind of thing. Ethereum built the culture that it needs to build. They are very, very focused on solving this problem. That's, I think, actually I think it's important for the future of humanity. I think it is a good, but they have a very specific mindset for how they approach designing systems. Cosmos just starts from a totally different vantage point. They just have a different set of problems. Like, Ethereum now probably has built the winning chain that has the most momentum and consensus behind it. The question is, can you change the way the influential people in Ethereum think from, okay, we've built what we need to build here in terms of like an economically neutral, credible system, and start like change to how we need to change to attract a whole bunch of users. And then Cosmos needs to, they got to figure out the thing that Ethereum has perfected. They got to figure out economic security. They've got their own cold start problem to solve. So they're converging on the same thing. They just have different starting points. Ethereum's in the lead, that's for sure. But I don't know how it all plays out.
Let me ask you this: if you have 1 million new blockchain users, someone who has never touched a chain before, doesn't even know what MetaMask is, etc., where do you think they aggregate? Like what is the thought process? What's the like mechanics of them getting?
I think they aggregate to whatever. I don't think they aggregate to like an Ethereum or something like that. I think they go to whatever application is the best application.
Yeah,
exactly. That was going to be my perspective as well, which is it doesn't matter which chain they're on. It matters which applications they're getting driven towards blockchain.
I heard the most like left bell curve, like Occam's razor take of why someone chooses Cosmos versus like building an L3 on Ethereum when I was in San Francisco and met some of these founders is it's kind of like starting your website with like when we launched Blockworks, we started on Squarespace, and then we went to Webflow, and then eventually we built a full stack like web app, but only after year 4 when we needed like to service millions of users. And so like what the founders were telling me, like their thought process, they're like, oh, we're all just going to build on like the OP stack or Coinbase Base or Arbitrum, because they give us a full suite of developer kits. But they're like, that doesn't mean that in like 3 or 4 years, like if we're successful, like if the L3 or if the ETH people, like the Base and Arbitrum and stuff, can't support us being able to build more and more of the stack, then we'll be forced to go to Cosmos. Just like Blockworks was forced to, like Webflow and Squarespace weren't able to give us what we wanted, so we were forced to go build our own thing, even though it's much harder to do that.
This exact effect is happening with games right now, and I'd say games is the canary in the coal mine for maybe not millions of users, but like tens to hundreds of thousands of concurrent users. They're trying to build on top of mainnets or L2s. And it's sort of like mainnet, okay, that didn't work. L2, like Polygon, maybe. But now they're like, okay, we need our own app chain.
Well, why
there's just no question.
Tell them why, Michael. Why do they need their own app chain?
The costs are prohibitive, but also the blockchain itself is not capable of running that many concurrent transactions. If you have hundreds of thousands or millions of users concurrently, you either need to have almost zero interactions with the blockchain for that interaction. Like, you're playing the game, you win something, great. This thing gets dropped into your wallet, blah, blah, blah. Whatever that blockchain interaction is a transaction that exists on chain. Well, if you have millions of concurrent users, that's going to be hundreds of thousands of concurrent, transactions. That's just not going to work on a blockchain. So you either need to design the chain or design the game in a way that interacts with the chain in like kind of a weird way, or you need to run your own infrastructure.
Yeah. I guess I mean, there could be a sweet spot here. We're talking about it like it's black and white. There's like a sweet spot between app specific, like an app chain and like a roll up centric future could just be like sovereign roll ups, which I don't know.
Dude, you might have missed something. That exact spectrum was the whole point of last season. It's like L3's on Ethereum on one over here, full sovereign Cosmos app chains over here, and then in the middle is like what Sovereign Labs is kind of doing, and there's or Celestia or something like that.
Yeah, that's probably the.
And
there's the Celestia. Yeah.
And there's honestly like,
oh, that's probably why it was in my head then. Yeah, because I remember you talked to the Celestia guys a bunch, and
it's I find compelling reasons for each one of these things. Yeah. I just, it's hard to know yet.
Let me give you the biggest left of the bell curve take on just why ETH L1 will continue to be dominant. All of these L2s, which I generally think we have a consensus that, even though the long-term future is potentially uncertain, they're going to be massive, fully diluted valuation outcomes for these L2s. They're all launching their tokens on ETH L1. ETH L1 is like the NASDAQ of crypto. If you launch your token on some other chain, like, not to shit on Polygon, say you launch your token on Polygon, like, you don't have nearly the same access to whales, to institutions, to individuals that you would as on ETH L1. And so all the biggest assets are going to continue to be there. And I think over time, you build a real financial moat as a result. Like, do you want to IPO on the NASDAQ, or do you want to IPO on like the Belgium, Southern Division
Toronto Stock Exchange?
Like, of course, you don't want to.
Not say that.
The TSX.
Hey, don't make fun of the TSX. That is a reputable stock exchange. The TSX is the Toronto Stock Exchange. It's known for basically, like, back in the day, people would wildcat oil wells and like kind of dig their own oil pits, and they would like IPO these pink sheets on the TSX, and it was like wild and crazy. And Canada's pretty buttoned up now, but the TSX is still kind of like a degenerate stock exchange. So they keep it real.
Totally. I didn't mean to disparage the TSX. There are about 15 companies that are super happy to be listed there. So,
Galaxy's listed there, so just
I know. So I'm just messing. I think it's like these are interesting. These are interesting debates to watch play out. I think there's a natural. I don't know. There's a natural. You know what? Actually, you guys got me thinking. By the way, about now that we're just talking about some of these things with brand and stuff. We had a podcast maybe like a month or two ago talking about is ETH money? Is there a monetary premium there, or like is Bitcoin going to win that monetary premium? And I still think that my opinion back then was Bitcoin has this brand that's like very easy to understand, and it will do. It's much simpler, I think. But I think it's a little bit more complicated than that, because I think in an ideal world, the problem with Bitcoin as the base money is that there's no elasticity to it at all. I actually think ETH's monetary design is much better. Like, it makes more sense. But I also think, putting it in the context of where we are in the world right now in the macro, I think things basically move in intense overreactions and then intense corrections to fix those overreactions. And the big problem with like how everything works on the fiat L1 is that there are no checks and balances, and it's grown to this like crazy growth and way oversupply of credit. And I think it overcorrects to Bitcoin, even though you guys kind of did make me think about it. And I kind of do think that the monetary policy of ETH is maybe better, but I still do think Bitcoin ends up. And you can like Bitcoin, they're talking about exporting Bitcoin or properties of Bitcoin within rollups. It's a way to export Bitcoin timestamps to Cosmos chains to prevent reorg attacks. That's pretty interesting. Like, one of the problems for a Tendermint consensus is it's sort of vulnerable. There's instant finality, but you're sort of vulnerable to these long range reorg attacks, which is why there's an unbonding period of, I'm pretty sure it's 21 days in Cosmos. And that's a problem for like liquid staking in Cosmos, where the way you're supposed to balance that out is through an arbitrage. And if you have a 21-day withdrawal period, it just makes it very difficult to run that sort of trade. So if you could pay a little bit extra to ensure against a long range reorg, you could reduce the unbonding period and make it much easier, like add a whole bunch of liquidity to that protocol. That's Stride protocol in Cosmos, which is super cool. Shout out Aiden.
Mike, you're going deep, man. You're getting deep in the weeds of this stuff.
Dude, I've been
That's
cool. I've been deep in the weeds. Yeah. It's
Mike, tell us how much MEV content you've consumed over the last like 2 months, man.
Shout out sister pod. That is it's been good.
I actually got to shout out Hasu. He's been great. He's a good dude, smart guy. MEV is one of those things where it's like there's like rabbit holes, and then there's like Alice in Wonderland rabbit holes, and then there's MEV. And it's just you can go so deep, and it's pretty complicated stuff, but it's good. It's been good.
Any takeaways from the MEV learning so far?
Yeah, I actually think that wallet right now, there's a lot of the discussion in MEV is based around like block space auctions, and people have been worried forever about centralization on the validator level. Whereas really where you're going to have to worry about centralization is around the wallet level. And everyone's going to move to I think private order flow is probably inevitable. And then the way that MEV is going to get allocated is through order flow auctions instead of the block space auctions will still exist. They'll just be smaller and a less significant portion of MEV. And I think the worrisome layer for centralization is going to be wallets probably. But you might actually get rebates for trading on these platforms because that's how there will be MEV that's redistributed back to users to the point where you could sort of be getting paid to trade, which would be a cool user experience. Can we get a check on where you guys think we're at in terms of markets and whatnot? We got a handy chart here. Shout out Garrett who put this together. But it's been a very good start to the year for crypto in general. But because this is a macro pod, it looks a little dicey out there still for macro. So I know we kind of ask you guys this each week, but what are your sort of latest thoughts on where we're at?
We had a conversation yesterday with one of our core LPs for one of our first funds. And I think the salient quote from that conversation was, and he's, a reputable hedge fund manager, from the 90s and has just like seen markets over the last 3-4 decades. So just like very well attuned to what's going on. And it's always great to talk with them and just like get a sniff test of what's happening kind of broadly. He said that amongst the conversations that he's having, there are absolutely zero people that are bullish except for him.
He loves to get in the mix when things are looking dicey, and he's just seen this so many times that appreciate his perspective. But he's like basically the last, and he's like in the New York circle of those types of people, but he's kind of the last bullish person. And I think that's kind of what you need for these things to continue. Like, I think we've largely seen the snapback rally just because we were so beaten down last year. But the real question is where do we go from here? And not a whole lot of people believe the bullish case. The bearish case is very easy to make, but I don't know. The bank stuff is kind of slowed down, it seems. Doesn't seem like we're going to be talking about that in a month,
I think the bank stuff has slowed down. So I think of it in terms of categories. If we take venture capital, you can separate that into growth equity and sort of early stage. Early stage, I think, is pretty much like limited from the exposure of what's happened over the last 18 months, just given that you're investing in an earlier stage. Like investment pace has slowed down, entrepreneurship. A lot of people aren't jumping in to, figure out what company they want to build. They're trying to fight for their jobs. Growth equity, I think, is in a very troubled state, but we've known that literally since like middle of 2021 when everything started to hit the fan. The things that I think are relatively new are commercial real estate, where you have $1.5 trillion of commercial real estate debt that needs to be refinanced by the end of 2023. The fact of the matter there is you've got hard assets. You also have sort of like this need to refinance versus, not financing. Like there are elements where that could really blow up, that could really get bad. The thing that I am tracking now, which has kind of been over the last couple of months, just thinking about this. The one thing about commercial real estate is it's fixed rate lending. So all of the terms of those loans are generally fixed at whatever the interest rate was when they made those, 7, 10, 15-year loans. The thing that is not fixed, that has gone skyrocketed, private equity. And you think about taking the exact same concept, which is a company, you lever it up, 5, 7, 10 times, where you're putting 10% equity down. That company then has to pay LIBOR plus 500 basis points, LIBOR plus 400 basis points. Like those are usually the leverage finance terms for how you're leveraging these companies. So you've got a simultaneous effect of, number one, growth and revenue prospects subdued and declining. Number two, you've got interest rate increases that are making it such that the debt service alone is the entire cash flow for the company. And so you kind of have this like effect of Blackstone, Apollo, the major, and not specific to them or their portfolios, but like the major private equity firms and the portfolios that they put together. These companies are levered to the hilt, and you've got increasing interest rates and decreasing growth. Something is bound to break at some point. And we're starting to see that, obviously with the Blackstone real estate portfolio, that I think is a little bit more fickle than what I'm talking about. But you ultimately do have, these companies that are just not going to be able to make their debt service. And what do you do when high yield debt at a corporate level gets blown out? Keep in mind, high yield debt is superior to equity. Like what happens to the companies and the equity beneath it? There's a lot that's going on.
Yeah, the commercial real estate thing is interesting because, first of all, it's so large, and I actually heard there was a good amount of variable rate financing that happened for commercial real estate, and they have fixed yield on the asset, right, like the cap rate. And the other thing about commercial real, at least like offices, is that I think the jury's kind of out now that work from home, hybrid work is going to be a thing forever. So these assets need to get re-rated. So not only are you going to be underwater on the financing, but the assets themselves need to get re-rated. And I think that's the problem.
My good friend is a commercial real estate developer in a major city. And I was like, how does this work? Like this whole process. And he's like, well, I've never repaid a loan. I've always just refinanced it. Like there's never been a time where he's had to like, I've borrowed X and like, here you go. And like, there it is. And it's paid off. It's just like always revolving. And
this is the Michael Howell thing.
Exactly.
You gotta get the role.
Exactly. And I was like, well, which banks are like doing these loans? He's like, pretty big banks, like Bank of the Ozarks, like Deutsche Bank is in there, like, like these random banks that I've never heard of. I don't know anything about commercial real estate. I was like, this is going to be a disaster. I'll call you in 12 months. Yeah. So,
Bank of the Ozarks.
Yeah. Apparently they're deep in it, but I also went to a school. I came out of undergrad. I went to USC, where the cool thing to do coming out of school was become a real estate developer. Because like people think Los Angeles is the city of entertainment. It's really like the city of just like never ending sprawl and never ending developments. It's going to be a rough one for that crowd.
We also graduated into a decade of zero interest rates.
Dude, when I graduated, I was like, you guys are just printing money. How is it this easy? They're just like, yeah, you just build physical stuff and then people like come in and they'll pay for it. And like you levered it up 9-1. It's like, man, that sounds great.
Here's the counter argument to this being like a huge catastrophe is that it's really not in the interest of cities to see like a whole street of like office buildings basically just completely wiped out.
Have you been to San Francisco recently? It is terrible.
You want to bet?
I was on Market. I went on Market Street and was gonna like walk to your guys' office, and I was like, I'm getting an Uber. This is
Dude,
I'm
you
literally
go to
scared.
Market
Like,
Street and you're like, something sinister has happened here. Like, what did you
yeah, I
people
went
do
to that taco
to,
place
like,
next
make
to
it
Market Street, and I was like,
You guys want to get the guess what percentage of commercial real estate loans are held by small banks?
70?
Yeah, it's 70%.
Guess what? So, okay, I will say, like commercial real estate, there are 5 different categories that you could broadly put into commercial real estate. One of them is offices. A lot of the value is offices. So it's not like commercial real estate as a whole is getting screwed over. Like, no, if you own warehouses right now, you're doing really well. If you own offices, it's a tough time. But within offices, do you know what the in the entire United States vacancy rate is? And this isn't like we have a lease and we're paying it, but like people aren't coming into the office. This is like 0 leased office space. Do you know what that is? Hit the highest mark in history, 18.7%. 1 in 5 square feet in the United States of office space is unleased.
Commercial real estate feels a little bit like crypto, where it was just like anything goes for a full decade. And now it's like, okay, half of you are in trouble.
we just don't know which half.
okay, so you guys want to hear? So there's going to be a weird like second order impact of all of these vacancies, which is that there are all these green rules that got put in place a couple of years ago in Europe that said if you're under a vacancy, if you don't have like a, let's call it like 80% vacancy in your place for like 2 years at a time, you're not allowed to operate that building. And I think they just like didn't think about this and didn't think about like COVID obviously happening. And I don't know. I don't know. I have to look up those. I have to look up those rules, but I remember those rules were put in place. I think in like in London, for example. So I wonder if you could see those going into effect. Well, I gotta.
What do
I
you
gotta
do with the
Google this.
building? Just like pack it up, just like the EU demolition squad.
I mean, literally,
You start to offer. This is what I was getting at before. You start to offer extreme, and the government starts or the city starts to offer extreme incentives to renovate the building or convert the building.
That will work 100%
which,
of the time.
which
I'm
city?
sure that will. Just like make the office more
Listen,
open and like put like a smoothie machine in. That's like not going to get people to come back.
I'd come in for some cold brew.
That's also a very European solution to that problem.
I mean, you guys are out here serving coconut water, so you guys get the incentive game.
And the
we got a
Uchi
nice
green
office.
teas from Japan. We don't mess around.
Flex on them.
Men of culture.
It's true.
Yes.
The line from our investor who we're referencing earlier was that he has never seen this in decades, but people are literally walking away from buildings. That means like you own the building, the bank forecloses on you, and they're just like, all right, that's it. I'm done. I'm out. That means that every single person who works in the building, they don't have an owner. Every lease terminated. Every single person who's janitorial, operations, or has like a retail establishment in the building potentially gone.
I answered I was wrong about the green rules, but I was right in a sense. It has nothing to do with the vacancy. It's that every like 3 to 5 years you have to upgrade the building, and it's always just been like, oh yeah, we'll upgrade the building. But now there's no incentive to upgrade the building because no one's actually staying in these buildings. So London, it is London. London is already starting to do this. I guess they started to do this 6 months ago. They're shutting down buildings because they don't meet the green standards. But there's no incentive to improve to hit the green standard anymore. So
Fire them into the sun. All the European. Like, imagine you're like trying to make your office work and it's like not going according to plan, and someone's like in your ear talking about how you're not green enough because you didn't upgrade the building. Can you give me 5 minutes?
You are not green enough. Oh my god. While we're on just random subjects here, do you guys see the announcement from Dune that they're integrating some form of LLM or whatever? So now you won't need to know SQL. You can just type in plain English what you want to see, and you'll be able to to pull that info.
Learning
Brutal for all those junior
I know
analysts.
learning
out there.
SQL is like learning cursive now. Like you really do not need it, and it's like I had Token Terminal up on one computer yesterday, and I had Chat GPT up on the other, and I was like, man, I'm supercharged right now. And if I can just get, like Dune Analytics to work with just natural human language prompts, there's going to be a lot of junior analysts that are looking for something to do.
We all thought that white collar jobs were going to remain, and the blue collar jobs were going to get crushed. And boy,
Yeah,
it is the opposite.
yeah. It's
I mean, the creatives went first.
Yeah, we killed all the artists first.
yeah. New order is creatives go first, white collar second, and the third people are like the guys who like weld your pipes, and they're going to be living like kings.
I was having a conversation last week with the head of some game company here at GDC, and he goes, "Yeah, we used to have a creative team of 8 people. Now we use Midjourney." Like, boom, gone.
Did you see that Elon Musk called for a moratorium on AI research for 6 months? You never know with that. It got reported on in the Wall Street Journal and pulled up the article, but
No, it wasn't just
You never
Elon.
know.
It was like
People.
10,000 or like 1,000 like AI big brains or something.
I'm worried about this stuff. Like I've definitely sat up a couple nights and been like thinking about AI and like where it could go. There is a non-zero chance that something bad happens. I also think Elon might be talking his own book a little bit because I do believe he has a startup in this race somehow now. No, he didn't get funded, or what happened to it?
He did. It's called
No.
No,
He's starting another one.
he-
It's called Based AI or something. It's like something stupid, some dumb name. But like, what is his proposal? We stop. We all just put our hands up and like go home.
oh, what do you
vacation?
what do you like when you're playing through some of these scenarios in your head? Like, what are some of the things you find yourself? Because I've also done that too.
So,
and I think
so one that I was thinking about is like, okay, cool. The education system, which is like totally broken. Now if you can get the best tutor on the planet, it really is somewhat of an equalizer, in that regard. But then I was thinking about if this machine knows everything and knows it to a more insightful extent that you could ever, and it's better at everything, and it's faster at math, and it's better at writing, what's the point of you even learning it? Like, are you just is the new education like be the best prompt engineer possible? That feels literally like a wage cage, style scenario where you're just paid to like press a button every 5 hours. I don't know. That was kind of the stuff that I was thinking about.
I have a more
I
optimistic
think the
take
same
on it.
concern happened.
Okay. What's the more optimistic take?
I'll tell you the optimistic take. You guys have probably heard these criticisms, right? America is falling behind in math. Like these liberal arts colleges, they teach you nothing. And instead, really what we should be doing is teaching math and engineering because those are where all the jobs are. Yeah, again, the irony of this might be that those programming languages, like you don't need to learn because a computer will learn that for you. And like maybe at the end of the day, what this stuff still can't really do is reason particularly well, like higher level reasoning, critical analysis. Frankly, I think life would be a whole lot better if everyone was forced to take human history as a major. I think it would improve a lot
Should you
of stuff
still learn
in
math
society.
in a world where ChatGPT exists?
Yes, because how do you know that it's accurate? How do you know how to apply
But
it?
Vance, it's not
correctly?
just ChatGPT. Like, why would we don't need to do math? You're not doing math every day. You can just Google, like you can just type it in on a calculator. But but it's still important to learn math.
Yeah, I guess it's important to like learn things in order to be able to reason through them and be able to prompt this thing. But I don't know. It just feels like the human input is less and less valuable over time, and that's
Well, here, let's go back 20 years, or let's go back 30 years or something, and someone's like, you're one day going to be able to search the internet for literally anything, and it'll just answer it immediately for you. You'd be like, well, what? Like, why would we ever learn history if you could just search this stuff? And that's Google. And like,
I viscerally remember.
I'm just trying to justify my history major here, guys. It's a liberal arts. This is a liberal arts
Me
major trying to justify it to himself. Yeah,
How much time do we have on the pod?
yeah.
I viscerally remember, like, I grew up in Palo Alto in the 90s. I viscerally remember Google happening and being like, oh, great. Now all our kids are just going to like Google their homework. It's like, no, okay, you can use Google as a tool to do your homework just as everybody does and everybody did, but it's not like it's going to do your homework for you. You still have to be able to reason. Like my personal perspective is like the reason why you go to college, the reason why you study something is not to learn that subject, it's to learn how to learn. It's just like you're using that subject matter as a placeholder to be able to understand how to reason through things, so that when some technology comes along and it's just like, okay, great, this now gets 20%, 50%, 100% easier, you can actually use it, but you know how to reason. Like the history major, or personally the economics major,
classics major,
it's not like I'm using that every day. Well, maybe more so than history or classics. Jesus.
I remember walking downstairs into the basement. It was like 4 a.m. and Mike's just like reading the Iliad, like locked in,
tapped in. You guys are just finger painting the whole time.
yeah.
Like, what are you doing, buddy? He's like translating the Iliad. Let's go.
That was like a huge portion of my college experience, like translating, like the Iliad and like Aristophanes and these like ancient Greek texts. That's like my college experience. So I put that to use every day, obviously.
Where are the rest of your classics major colleagues today?
Couldn't tell you. There were 9 of us. There were 9 of us.
The history department at Emory got defunded. They
The
just
history
wiped
division?
it. Full 17 of us. Yeah, exactly.
Yeah. But
I'm bullish.
I don't know.
I'm bullish AI.
I think it'll be.
I'm bullish on all the
interesting.
crypto people
You have to
using
rethink.
AI first too. Like the crypto people are going to get super powered by this first and foremost, because
Everybody's going to get super powered by this, and also like once you put a new technology out into the world, you can't pull it back. And that's why this like open letter is a stupid thing. It's like when we invented the printing press, it's like everyone was scared about like commoners getting access to books and like being able to like read the Bible for themselves.
Whoa. They don't know how to read that.
look at where it got us. I mean,
Like,
The church had a pretty thing. They had a good thing
I
going
know,
for a long time.
yeah,
They honestly did.
general ability to read really kind of did not do them a good service. But
Did not.
I
No.
don't
People started
I
asking
know.
questions
that they were not
that the
prepared to
church wasn't
answer.
prepared to answer.
I don't think people are going to stop building AI. I kind of think this is going to fall on deaf ears.
So we've like gone down the rabbit hole in a couple of different ways on just like AI concepts from a venture investing perspective. The thing that is undeniable is that there are hundreds of thousands of people, individuals, who are on these betas or on these wait lists. Like there is such a thirst for being able to like test out these different tools, to be able to try these different systems. I think, sure, crypto will be an early adopter just because it's crypto and we're the earliest adopters of everything. But there's so many people that just want to play with this stuff that are going to like experiment with it.
it's the fastest growing user base in the history of any product in the world. It's the
Yeah.
best launch in the history of any consumer product
Zero
going live.
marketing.
It's the fastest growing.
Zero marketing.
Everyone wants to use this stuff.
Crazy.
This is why we need WorldCoin.
I'm sorry, how did you tie that together?
You really just want
You don't know the
full stack
thesis?
Sam Altman.
No.
No one man should have all that power, you know?
All right. This was a fun one.
Cheers, fellas.